Good morning and welcome to The Street on BNN Bloomberg. I'm Roger Peterson. Coming up on the show today, Brooke Thackeray is a research analyst at Horizons ETFs, is our guest co-host, and at 8:30 our featured guest will help us break down the latest Canadian inflation data coming up then. We also want to hear from you, of course, on First Call. Call us with your questions on ETFs and North American large caps, and we'll have Brooke answer as many of them as he can. The number to call, 1-855-326-6266. We will open the phone lines in about 30 minutes, and of course you can email us, and the address for that is firstcall@bellmedia.ca. Now, here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. Prime Minister Mark Carney's government faces a confidence vote on its budget today. The budget proposes spending increases for defense, housing, and new infrastructure projects. It also made headlines for running a deficit of almost $80 billion for 2025-26. To avoid a new election, the Liberals need at least 2 votes from opposition members or 4 MPs to abstain. Well, Canada's housing market bounced back in October. National home sales climbing 0.9% from September. According to data from the Canadian Real Estate Association, the benchmark price of a home rose 0.2% on a seasonally adjusted basis. The amount of new listings declined. However, sales activity and the benchmark price were both lower than a year ago. Shares of Alphabet are trading higher, and the pre-market regulatory filings on Friday showed Warren Buffett's Berkshire Hathaway acquired almost 18 million shares in the Google parent during the third quarter. Buffett now has a $4.9 billion U.S. stake in the technology conglomerate. The investment firm further trimmed its holdings in Bank of America and Apple. Time now for our top line story. Canadians could be heading back to the polls for another election if the Liberals' budget is shot down in a vote happening later today. CTV's Jeremy Sherrill has more.
Inside the halls of power, high stakes to start the week. A crucial confidence vote in the House of Commons that could come down to the wire.
It's going to be a particularly dramatic and suspenseful day.
It could be close, like close as 2 coats of paint, real close.
Prime Minister Mark Carney's Liberal government will need help to pass its budget. 2 seats shy of the required 172 for a majority in the House of Commons, the government needs 2 opposition MPs to vote in support of their budget, or at least 4 members to abstain.
It's going to be about math, it's going to be politics, it's going to be about who wants to trigger an election. And the answer is no one really wants to trigger an election.
The Conservatives have been clear they won't support the budget, but leader Pierre Poilievre has stopped short of confirming whether all his MPs will vote.
Are you confident that all of your MPs will vote against the budget?
100% of our MPs oppose the costly Carney credit card budget.
The NDP has also signaled voting with the government isn't likely, but interim leader Don Davies has indicated his MPs could abstain.
I think they're going to have to finesse it, because if all 7 of them came in and voted against the budget, it could defeat it.
The Bloc Québécois has indicated it'll vote against, while Green Party leader Elizabeth May has said she won't support it either, but could be persuaded otherwise, which means an election is on the table, with the outcome of Monday's confidence motion still unclear.
I think a lot of people hope that doesn't happen, but it's definitely a possibility.
Now, no party has indicated an election is what they actually want, but there is concern the numbers could be so close, a simple miscalculation could send Canadians back to the polls.
That was CTV's Jeremy Sherrill. And let's bring in our guest co-host. Brooke Thackeray is a research analyst at Global X. Thank you for joining us. We appreciate it, Brooke. Your thoughts on the budget? I mean, it's likely going to be passed. I don't think anybody wants an election right now. Do you feel it should be passed, though?
That's a tough one because there's a lot of spending. It's a large deficit. $78 billion the first year, $321 billion over 5 years, and it's going to be hard to show that this actually pays off here a little bit. So my concern is the amount of spending that's going on overall.
Mm-hmm. Well, we saw there was a report out from the interim parliamentary budget officer on Friday that had some concerns that some of the accounting, when it came to investments and tax credits, and that it might not be the way it should be done. And he also had concerns about the fact he doesn't think they're going to meet that the deficit dropping down, but the deficit ratio, it doesn't think it's going to change over the next 4 years. Or he's not optimistic that can happen.
Yeah, I mean, usually with budgets, most of the time governments actually spend more than they say they're going to spend, and there's something else. And on top of that, there's very aggressive assumptions being built into the budget as far as growth goes, and there's no recession built in there. And and I'm not saying it should be different, but that's the way it's done.
Yeah.
So there's risk to those numbers with the deficits and debts going up. And that's gonna have an impact, because that means more government borrowing, which means we probably will see higher interest rates really have an impact here, because it's gonna be more expensive for governments to borrow, the Canadian government to borrow over time. So there's a lot of risk, and you have to show that that's actually paying off, in the end, and that's going to be the difficult thing.
Well, and I think, and that's what they're trying to argue. They're not taking into account how the spending is going to increase. Income coming in and increase strengthen the economy, but is that a realistic expectation, you think?
I don't. I think
tough question, but
I don't think it's a realistic expectation. I don't think we're going to see the growth that's going to overcome the amount of spending that's taking place here. The focus has really been on government approved projects, basically, versus through the private market and fixing the supply side. Which would be very different as far as removing regulations and making it easier for a company to start business and really proceed. So it's really been focused on that. So I'm not convinced that we're going to see the amount of growth that is sort of saying, hey, this is where we expect things to develop from here.
Why do you think they're staying away from that, or cutting regulations and removing some of the red tape?
Yeah, I think they're just they're saying the government's the more important factor. There's a lack of focus on private companies here, really, overall. I think they're saying, well, we can provide the answer here. And they're not the only government in the world that's doing that at this point. But that's been their solution here. And I really think it would be, I'd love to see more of the red tape being removed.
What's some of the biggest red tape to you?
Well, I mean, if we start to get into the energy sector, we really don't have a plan to say, here's what we want to do as far as removing some of the regulations, as far as the pipelines being built. Because oil companies are really looking for a 20-year plan. They're not going back and forth. They want commitment to say, here's what has to happen, rather than, we're going to leave the caps on, or whatever it is, or the tanker ban, et cetera. We're going to leave all that there, but we're going to have a couple of exceptions. That's not going to really encourage private companies to come in and expand outside of their few exceptions that the government's going to force through overall. I think the better play would be to actually just change the regulations so that companies are incented to actually set up shop.
And stay. Okay. On that note, we're going to take a break, but take a look at the markets before the bell coming up. See how things are shaping up on the markets right now. We'll start with the U.S. futures. Some cautious optimism as investors await key earnings reports. We're going to be talking about them in just a second. NVIDIA, Walmart, Home Depot. And right now you can see they're all down right now, but pretty minimal. Dow off by 0.11%. And the NASDAQ off by 0.0708. And the S&P 500 also off by 0.12%. Almost a wash. Overseas, the major Asian markets, Japan dominating the news there. Its economy contracted 1.8% in Q3, and comments by its prime minister over how any attack by China on Taiwan could trigger a military response by Japan, fueling concerns in that area. A bit of a diplomatic row, and you can see everybody ended up in the red right now. The Nikkei off by 0.1%, Hang Seng down 0.71, and the CSI 300 off by 0.65. Moving over to Europe, and downward trend is mostly flat earlier, but now you can see it dropping a little more. They are all awaiting that key U.S. data that's expected to be released later. And got the FTSE 100 down 0.22%, the CAC 40 off by 0.48%, and the German DAX down by 0.66%. And how did the TSX do on Friday? Strong gains in energy and technology drove the market higher. Up over 30,000 again. It was up 0.24%. Let's see who some of the movers were. You got CES Energy up 16.37%, Celestica 0.591%. It closed up as well. Curaleaf, another hit, down nearly 20%, and Superior Plus down more than 21%. Taking a look at the metals, gold on its way back down again. It's been a bit of a roller coaster recently. Investors looking for clues, of course, about the next move on rates by the Federal Reserve. And right now, gold's off by 0.22%. Silver flat, still over $50 though. So they're all having good years, but right now it's a bit of a roller coaster. And copper is off by 0.84%. And taking a look at the oil, we had mixed supply signals. That has the markets trying to figure out the next move. And we saw that Western Canadian Select was up 3.3%, and south of the border, WTI is back up over 60 again. It's up 0.32% right now in early trading. Well, technology shares are driving gains in U.S. stock futures as investors look ahead to earnings from the AI behemoth, NVIDIA, I think we can call it that, and the results as well from a slew of other major retailers also coming out over the next few days. So it's going to be pretty critical week for traders trying to figure out what's next when it comes to the health of consumers and the economy in general. And for more on this, our guest co-host, Brooke Thackeray, joins us now. He's a research analyst at Global X, back with us. Thank you very much, Brooke, for joining us. This is we have big weeks, and then this is a big week. This is the NVIDIA week, isn't it?
It's a NVIDIA week, absolutely, especially after what we saw last week. It was really interesting because we saw a lot of questions around AI. And it wasn't so much about the chips or the computing power or do we have enough chips. It was about the bottlenecks. It was about energy. Do we have enough energy? Do we have enough data centers? We saw CoreWeave come out last week and say, hey, we're not going to do that well coming up soon because our data center's not opening. And there's more and more, all of a sudden we have all these plans, but there isn't the energy in the short term. So we saw a lot of questions around that. And even about the funding, because we saw previously that Sam Altman come out and say, well, maybe the government should be backstopping us with $1 trillion or something.
Sure, that went over well.
Yeah, it went over well.
We'll leave it alone.
So he came back and he got AI to write a script for him, and it was a response, 1,500 words, and put it out and said, well, I'm not really asking that. But so is there enough money? Because they're putting a lot of money in. And we're seeing that, it's eating up the cash flow of these companies.
Are those bad? I mean, they're not, obviously don't want problems, but those are not as bad as other problems could be, right?
Oh, absolutely. So with NVIDIA, it's a little bit different because we're not dealing with the bottlenecks. And they have a good reputation of coming out and beating expectations and giving rosy forecasts.
Yeah.
And then meeting those rosy forecasts. And this has been their track record. So this is a pivotal week because we saw some concerns last week, and all of a sudden it's like, hey, if NVIDIA comes out and disappoints for some reason, which is not typical, maybe that will really cause some concerns. So it could go the other way as well.
And it's also, I mean, what's a disappoint too? I mean, they could beat everything, but if they don't beat it by enough, people were expecting it up here and they end up only here.
I think the disappointment would be their forecast. All of a sudden it's like, okay, well, maybe we see fewer chips being bought because the companies are having to pull back because they're not getting the energy down the road. I'm not sure I expect them to say that because they really like bullish forecasts, but that would be a disappointing aspect. They could still have great numbers, but the forecast going out forward.
But again, things that can be overcome though, those ones, right? As opposed to, well, we're not selling anything.
Yeah, but it's still going to put some questions around that and say these other companies that are bleeding all this money, and that's going to have an impact on those companies in the short term, and that might just spill back and affect that whole area.
Would people be willing to give them the benefit of the doubt if it is a little off, or is it going to trigger?
So. No.
It's just going to...
I'm not expecting that to happen necessarily, but I don't think they'll give them the benefit of the doubt. If they come up with something that just isn't quite as good as expected, I think there'll be a lot of questions, particularly because we've seen the concerns building around that. And for instance, on the credit default swaps in some of these AI companies, we're starting to see them rise a little bit, which means there's more risk, and that's because they're having to put so much money in as far as their capex goes, which means it's really affecting their cash flow.
And going to the other side now, just for a second, looking at Walmart, Home Depot, and I think Target is coming out with its earnings this week. Those will paint a different picture for different reasons, right?
Yeah, so there's been a lot of questions around that consumer. Is the consumer strong? And we've seen this bifurcation take place in the economy where it's the top, income earners still spending money and they still have money, but the bottom income earners are more affected by inflation, et cetera. They've basically run out of money a little bit. And we're seeing that. We saw that. We had a few fast food places come out recently, and they got hit hard. Chipotle, Wendy's hasn't done well. McDonald's did okay, actually.
Yeah.
But they came back and said, well, that was because of our higher income earners.
Interesting.
They actually saw in-store sales actually increase by 3.2%. They said that's our high income earners. But what we're noticing is the low income earners not spending as much.
Back.
So that's really what it comes down to, I think, for some of the retailers and Home Depot that expected to report. It's going to be interesting who's spending the money and see if that's going upstream as well. Because I do think consumers are cutting back across the board at the lower income level. But is it starting to spill in at the higher amounts? And we're seeing the home industry actually start to fade a little bit. We'll have to see as far as Home Depot goes as well, to see if there's that money, because even though it's not like taking a trip, it's still just some discretionary. I want a deck. Yeah. I'm going to build a deck and that type of thing. But we've really seen some weakness in the consumer discretionary sector, so that could spill back to Home Depot.
What are a couple of the numbers you'll really be looking for from like Home Depot, Walmart?
Well, you're going to look. I think same store sales increases and foot traffic. How many people are visiting the stores as well, and how much money are they spending? So if we're starting to see fewer and fewer people go, that won't be a good sign as well. Now, don't forget some of the retail numbers are not adjusted for inflation as well, but I think it's important to take a look at the amount of foot traffic.
Okay. We'll leave it on that note there, and we'll be back with Brooke to talk about why gold is on the radar for him. All right, time now for what's on the radar. And we're back with Brooke Thackeray, research analyst at Global X. And Brooke, you're looking at gold right now, keeping an eye on it. What do you have your eye on it for?
Well, I think the tailwinds behind gold. We've seen gold do extremely well through 2025. It's pulled back here a little bit from around,
but it's still up, though.
It's still up, absolutely. We haven't broken down. So the pattern that we've seen in gold is we've seen the consolidation, rally, a consolidation, rally. We just haven't seen that breakdown happen. And the tailwinds are still there. So I think we're in a pause at this point, not a peak.
Yeah.
And it's just looking for another catalyst to move higher. It's got some temporary pressure right now because the Federal Reserve looks like they're less and less likely to be cutting interest rates over the next while. I mean, they're still expected to cut, but not. They're expected to do 4 cuts in a year. Not too long ago, now it's 3 cuts in a year.
Yeah.
So this has had a little bit of an impact on gold, but the central banks are still buying. Governments are still spending money. So all the drivers behind gold are still there. And so I think we're in the consolidation phase, and I think we're just waiting until some sort of catalyst comes along, and then we'll move up to the next level.
And any indicators, have they considered not buying or slowing down? The Fed, the banks, or the governments in that?
Central banks are still buying gold. They've done some record amounts. That really started to happen. They've been net buyers since 2010. They really started to ramp it up in 2022, and they've been consistent buyers. So it's not really the North American central banks. It's more some of the Eastern countries. Poland's been a big buyer of gold, one of the largest buyers of gold as well. And we're seeing a lot of retail buying in China. So a lot of the retail consumers going out and buying gold. We don't see it here right now. There isn't that same excitement for gold, and that's another thing. If people start to get excited about gold, we could in North America we could start to see the price go up.
Almost like I remember in the early 80s when silver went. I remember my parents going through finding all the silver. They didn't want silver spoons and everything. We were selling it all, and we could see that going. Why are Eastern countries like Poland, why are they looking at it, and then here in North America, the federal banks are kind of staying away from it?
Well, I think it's
staying away from it, but
yeah,
not as engaged.
Yeah, well, for a fun fact, Canada has zero gold as far as foreign reserves for the Bank of Canada. So yes, we're not buying.
They're staying away for sure then.
Yeah. So there's a couple things I think going on here, and China's been a huge buyer over time, and so they're trying to set up some sort of alternative currency in the BRICS nation at some point. Now, not a currency you'd actually go out and buy items with per se, but a trading currency between countries. So we're seeing a lot of those countries that are part of that mechanism say, hey, well, we better start accumulating gold. And Poland, I can't say specifically for Poland because they wouldn't be part of that, but they just see it as being a more important aspect in today's world. And perhaps they're seeing the same things taking place, more money printing, and they're saying, well, where do we go? Do we just go to the U.S. dollar? But, we could see more inflation down the road for the U.S. dollar. And I think we're seeing a more importance of gold as part of the foreign reserves, like it used to be at one time. It's just coming back into favor.
And if you're looking at buying some, what are some of the best ways to at this point right now?
Well, so there's different ways. You could buy stocks, gold mining stocks like Barrick, we saw do really well last week. You could buy gold ETFs that actually own gold miners, or you could buy gold ETFs that actually hold the bullion as well as a representation. Or you could buy the physical product as well as an example. So you'd actually go out and purchase, just like the Chinese are doing at the retail level.
And I want to ask about this. Walmart sells gold, right? Was it Walmart?
It's Costco.
Sorry, Costco sells gold. We were just talking about. Can you get it at a price there that it's worth it?
Yeah, the price is actually very reasonable. I'm not trying to put a plug in
No,
but it's very
it's an interesting place to find gold, right?
Yeah, it's actually, and when they first came out with this last year, they kept selling out. They're like, every month they came back and it would be out of stock, and they kept going and going. So we're starting to see some sort of pickup, but the pricing's actually pretty good. And you can actually arbitrage the price, because Costco doesn't change their prices very often. Yeah. If the spot price rises, you can actually buy it sometimes at Costco cheaper than what the actual spot price is. I mean, not all the time, of course, but there's also gold bullion dealers as well that are very reputable that are exist in Canada that you can contact as well to buy gold if you wanted to do the physical route.
Of course, the trade-off, if you actually have it, you got to hide it somewhere.
Yeah, I think you're better off. I think you're better off to keep it outside the home and in a safe, if that's the avenue, or have somebody else do the storage for you.
All right, we'll leave it on that note there. But we've got more coming up after the break. We'll get the latest Canadian inflation data from Stats Canada and analysis from Jimmy Jean, chief economist and strategist at Desjardins. Also, of course, our phone lines will open soon for our first call segment. You can reach us at 1-855-326-6266. Send us an email, firstcall@bellmedia.ca. Prime Minister Mark Carney's government facing a confidence vote on its budget today. The budget proposes spending increases for defense, housing, and new infrastructure projects. It also made headlines for running a deficit of almost $80 billion in 2025-26. To avoid a new election, the Liberals need at least 2 votes from opposition members or 4 MPs to abstain from the opposition. Canada's housing market bounced back in October with national home sales climbing 0.9% from September. According to the data from the Canadian Real Estate Association, the benchmark price of a home rose 0.2% on a seasonally adjusted basis. The amount of new listings declined. However, sales activity and the benchmark price were both lower than a year ago. And TransAlta will acquire Far North Power Corporation and its 4 natural gas-fired generation facilities in Ontario for $95 million. The deal is expected to deliver an immediate increase in TransAlta's free cash flow. The company says it aims to seamlessly integrate the new assets while remaining focused on advancing their data center opportunities in Alberta. The deal is expected to close early in the first quarter of 2026. And taking a look at the futures markets right now south of the border, they are off right now. as they await earnings and everything else in an interesting week ahead. The Dow down by 0.14, Nasdaq 100 off by 0.1, and the S&P 500 off by 0.12. Stats Canada just released the October Consumer Price Index. The CPI rose 2.2% on a year-over-year basis in October, down from a 2.4% increase in September. Let's get more from Jimmy Jean, the chief economist and strategist at Desjardins. Jimmy, thanks as always for joining us.
Thanks for having me.
The numbers are just coming out, and you've had a chance to kind of early look at it. Initial reaction?
Yeah, well, we see a bit less of a deceleration than we thought, but still, at 2.2% from 2.4%, it's still some deceleration. And when looking at some of those the core measures, the Bank of Canada's preferred measures, you're seeing a slight deceleration as well. So I think the previous month, we had a surprise on the upside. Now, I wouldn't say that's necessarily the case here, and the Bank of Canada was pretty clear that it was happy keeping rates at 2.25%, provided that inflation continued to track generally its expectations. I think this number is not one that will raise some eyebrows on their end.
And now they say gas prices probably the key reason for the deceleration. Thoughts on that?
Yeah, well, and that was fully expected, sure. And we do see that 4.8% decline in gasoline. You're seeing also a bit of relief in food prices. You're seeing fresh vegetables come down on the month, so that certainly something consumers will appreciate. However, on the flip side, you continue to see rent as being the one of the main drivers of stickiness. So on a year-over-year basis, rent at 5.2%. It's still expected to trend lower. We expect rent next year to in most Canadian metropolitan areas to continue to moderate. That's the effect of course, the slower demographic growth, which will continue to weigh on housing demand. But from one month to another, certainly you're going to see some choppiness. So I think, broadly speaking, it still speaks to an inflation dynamic that is trending weaker. We have a weak economy as well, given the uncertainty. And so that will continue to make the Bank of Canada comfortable in terms of its policy, its monetary policy.
Now, we've seen the grocery prices. I mean, that's been the big concern with inflation over time. They've been higher than expected. And it's good news today that they didn't go down. They seem to be a little more contained, I should say. Is this a one-off number, do you think? Or is this more of a trend that we're going to start to see a more disinflation with the grocery prices where they're not going to have such an upward pressure?
Yeah, well, we have to remember the grocery prices were affected by counter tariffs. Those counter tariffs were removed in September, but in the September report, we hadn't seen the effect just yet, and that was to be expected. Even grocers had warned that it would take time before we see the full effect of that. But I think what we see today might be a reflection that those removed tariffs are starting to provide the relief that is intended to be provided, and so the next few months might reflect that. But then, in the back end, it will be more about what's happening globally, global food prices, and so on. So even in typical times, food prices can be very volatile. So we'll have to monitor that. But for now, I think the effect of the removal of counter tariffs is what dominates.
I'm looking at some of the details now. We're getting them in now. The prices for cellular services increased year over year after being on declines.
Yeah, and those the dynamics in that particular component are most of the time related to price adjustments for quality. So cell phone providers providing more services, more data in their bundles, and the way that statisticians account for that, it depresses prices. So we had a lot of relief coming from that, but it's not to say that cell phone packages were necessarily coming in lower. So it's just that more services were being provided. So we have to be careful when we look at that particular category for that reason. And it's the same thing, if it's flipped back on the positive side, it might not be that prices are going up. Maybe it's just the pace of improvement and innovation is just slowing a little bit. I think what the Bank of Canada really wants to see improving is the core measures that it tracks, and that will take into consideration, various outliers that will filter for those. And on that front, what we see is that one of its measures moved from 3 to 2.9%. That's sort of symbolic because it has a target range between 1 and 3%. So I think it will be satisfied to see that one move back into the control range.
Before these numbers came out, we saw the expectation for the Bank of Canada to cut over the next year. They weren't expected to cut over the next year. These numbers, do you think that'll have an impact on it, slightly move it towards even less of an impact overall?
I think those numbers are really consistent with the message we had, which was that the Bank of Canada was fairly comfortable at 2.25. Now that we have the federal budget behind, and that the Bank of Canada delivered a number of rate cuts this year, and so it wants to take stock of what the effect all of this will have on the economy. There's tremendous uncertainty. Business investment has been affected by the uncertainty, so that speaks to potential weakening in economic capacity, not least if you have some companies moving some of their production facilities to the United States. I think so. Those were some of the reasons the Bank of Canada put forward in justifying that, yes, that, on the demand side, the economy is going to be weak, but it's going to also be weak on the supply side. And if we cut rates too much, then we might end up having more difficulty controlling inflation going forward. So I think it still wants to wait and see how those dynamics play out, and particularly how that CUSMA revision process goes in 2026.
Okay, we're going to have to leave it on that note there. Jimmy, thank you as always for joining us.
Pleasure, thanks.
Jimmy Jean is Chief Economist and Strategist at Desjardins. Coming up, the fundamentals of Canadian senior living facilities are strong as demand for seniors looking for living accommodations grows. More on that when we come back. And of course, our phone lines are open. Brooke Thackeray is here to take your questions on ETFs and North American large caps. Call us at 1-855-326-6266. You can also email us, first call at bellmedia.ca. One of Canada's largest owners and operations of seniors living options, Sienna Senior Living, is planning to reach 95% occupancy by the end of the year as the supply of new senior accommodations is limited. We sat down earlier with Nitin Jain, the president and CEO of Sienna Senior Living, to discuss the growth expectations for 2026.
We know by data, in our fleets, this is not something people decide on the day off. So we have enough deposits and other things where if you're not at 95, we'll be very close to it, basically at that number. We are 3 months ahead. We previously thought it'll be Q1 of next year. Now we are going to be within this year.
Okay. How does it work for rent? Every time somebody moves out, do you have the ability to change the rent or to up the rent? And how do you determine that?
So we have two businesses. So I'm going to talk about retirement living.
Retirement living, I'm
absolutely.
talking about,
so there are annual rent escalations, which are pretty mandated by government.
Okay.
There are care rents, which are different. And then you have an ability to charge market rent. And as there's less and less supply of retirement homes, and when your homes are fully occupied, nearly 25% of homes are 100% occupied. And in those, you have a better ability to charge appropriate market rent.
Okay. So your primary source of net income would be what?
In retirement living, it will be both rental income and ancillary services, which includes care, food services, and in long-term care, it mostly is accommodation. where government funds care, but you cannot make any money off care.
Okay, and when you talk about retirement living, other services that include sort of PSWs, being hired to do certain things, handing out medication, or helping people who have mobility problems, is that part of services that you charge for?
Absolutely, and what is happening to retirement living is it has matured a lot more. Previously, people would think of retirement living as independent living, 3 meals a day. Now retirement living starts at senior apartments and goes all the way to assisted living, memory care, dementia care. And we have many retirement homes which will have that. So you could have a resident living in the same home who's paying, let's say, $4,500 in rent, and their rent covers 3 meals and light housekeeping. You could have someone who's getting a lot more services, medication, bathing services,
a dementia
care,
patient, for example,
and
yes.
their services costs will be different.
Okay. So that makes sense. Are you finding you have to expand care in the retirement home because of lack of ability in long-term care, meaning some of these people would be in long-term care if there was room?
Absolutely, and sometimes it's a preference. Long-term care does have long waiting list, and you do not always get to pick where you go. So for some seniors, being in the community that they are is very important. So there is the ability to get more and more services. And this is something quite unique about Sienna. We are one of the very few companies, especially public, we are the only company which is in both lines of businesses. So we are not afraid of providing more care, and I would say as far as to say that we are quite good at it. So ability to provide care for the appropriate price and making sure people are safe is going to become more and more important because the long-term care shortage beds is not going away anytime soon. And boomers are going to have a preference. They are not going to want to go wherever someone tells them to go. They will want to go where they want to live.
Which is part of the problem we've had with the government in Ontario, for example, where they were saying if there's not enough space, they're going to send people out of hospital, for example, to rehab in certain places wherever they are, which there was a lot of pushback on. Let me ask you about acquisitions and what your acquisitions have been like for the year to date.
So we have had our biggest year this year. We have around $800 million of acquisitions so far, which includes Ontario, includes Alberta, and we continue to look for opportunities, actually also include BC, and in both retirement living and long-term care. And not only we are acquiring, we are also building. So we just opened 2 brand new buildings, one in North Bay, one in Brantford. We have never built more long-term care beds in Ontario than we are today. And when I say we, I mean the sector. And these long-term care homes are full within 60 days when you open. So there's no lease-up risk. They're open. When you open them, you get full funding from government, and within 60 days, you're absolutely full.
So how many facilities do you have at this point?
We have 105.
105. Are you looking to do more acquisitions next year?
Oh, absolutely. We don't believe this is an abnormal year of doing $800 million in development and acquisition. We expect this trend to continue and do both acquisitions in retirement living, long-term care, and in all the 4 provinces that we are in today.
And are you focusing more on one or the other when you are looking at prospective things to acquire?
Again, we love both sides of the businesses. One is utility kind, stable, has no impact of tariffs, has no impact of economic uncertainty because government funds it. The other side is retirement, a lot more growth, but always has a bit more risk attached to it. And having half of each, which secures a dividend, lowers our debt cost, and provides us growth, we think we are truly unique in the public market space.
So you mentioned Ontario and Alberta for acquisitions. Are you looking outside of those provinces as well?
Yes, we are in 4 provinces today, Ontario, BC, Saskatchewan, and Alberta, and we'll continue to look for opportunities in those 4 provinces and hopefully add a province or 2 as we progress.
Does it make sense for you to add Quebec, for example?
Potentially, that market is quite different, but it is also one of the biggest market. More than 50% of all retirement homes exist in Quebec. So if the right opportunity comes along, we will take a look at it.
What makes that market different from the others?
I think it just demographics is quite different. There are a lot more renters in Quebec than there are in other provinces. So it's just the kind of living government actually has a subsidy for seniors in Quebec as well. So that is quite interesting in that space. And the market has been quite mature in Quebec than it has been in the rest of the countries. The absorption rate, which is the number of seniors who decide to live in a retirement place in Quebec, is nearly twice versus the rest of the country.
Interesting.
Yes.
So there's more take-up, and there's possibly more business there for you then if you do expand there?
Absolutely. As I said, 50% of all retirement suites in Canada are in fact in Quebec.
All right, Morella was speaking with Nitin Jain, President and CEO of Sienna Senior Living. Still ahead, the space race is heating up in Canada. We'll have more after the break. Interest from the federal government is marking a new and potentially lucrative chapter in Canada's burgeoning commercial space race. CTV's Garrett Berry has more.
Canada's space race, where companies like Nordspace are facing off to become the commercial hub for rocket launches and satellite deployments, is about to get a major funding injection.
It's going to be a catalyst. It's going to be an accelerant.
$60 million in cash from Ottawa is set to flow to this industry each year for the next 3 years at least, if Mark Carney's first budget passes in the House of Commons.
So to see it be called out so specifically in the Canadian budget is a huge vote of confidence, not just for companies and initiatives like ours, but for the Canadian public, that sovereignty in space is being prioritized for the first time.
Federal officials haven't said much about where this money will go, but the goal is to create a totally Canadian solution to get satellites up in the air.
Geopolitics have really changed the game for Canada in the last year or so.
U.S. President Donald Trump's musings about making Canada the 51st state seem to have boosted the desire to become self-reliant.
Canadians in a day out basis need banking and they have cell phones and global broadband and all these kinds of things that really do depend on satellites in orbit.
The players in this industry say they're ready to receive this money. Maritime Launch Services near Canso, Nova Scotia, has a launch window opening on November 18th. They'll attempt to send a Dutch rocket 100 kilometers into space on their launch pad.
The next step in the puzzle, the big gap for me, isn't really about the spaceports. It's really about the launchers themselves and whether they're ready to fly and get their payloads delivered into orbit. And that's not a small task.
Nordspace CEO Rahul Goyal says he understands the federal government wants this problem solved by 2028. Garrett Berry, CTV News, St. John's.
And when we come back, Brooke Thackeray will take your questions on First Call. Time for First Call, or as it goes sometimes, first email. And it's from Mike, who says, "Good morning, Brooke. I've enjoyed reading and getting educated from your books. At this time, given the increase in all major banks year to date, would you recommend a specific one or prefer a bank ETF? And would you wait for quarterly results coming out?"
Well, first of all, thank you very much for those kind words about my books. So the banks have done extremely well. And, you know, over the summer months, they've been outperforming coming up into now. And the reason is they've been in a good place. The economy is actually holding up better than people expected. Mm-hmm. And also, too, they have high dividends. And with a high dividend, if people are unsure, it's an oligopoly market. It seems to attract
never a bad thing.
It's never a bad thing type of thing. So right now we are in the strong seasonal period for Canadian banks to perform well. And they're coming up with earnings starting next week, later this month. We have Bank Week, I call it. So they've done extremely well. I think on the earnings, unless they're super, I think the banks will probably still continue to do well, but I don't expect them to have the same outperformance that we've seen from here. But I still think they're not a bad place to be in this environment. As far as what I recommend is a particular bank or a bank ETF, I would say that my preference is to go for a bank ETF. And the reason being is you're just taking away all the headline risk and you're really capturing the sector overall. And there's a number of good bank ETFs out there, including one at Global X where I work as well. They have a bank ETF. But that's the preferred way, unless you have a particular knowledge about a certain bank that you like, a certain policies or something of that nature, and you're looking at it from an undervaluation in that bank. But I think you're still better off, at least for a base case, to get a bank ETF.
Yeah. All right, let's leave it at that. Get a couple more emails in here. This next one is from Carl. What is your opinion on Baytex? Looks like it is breaking out.
Yeah, so the overall energy sector has done really well in Canada. And it's been surprising because we've seen oil prices slide down here, and we've seen Baytex do well here. We've seen a number of the oil companies do well. And it's really the difference between the supply side and the demand side where, The supply side, well, there's questions about whether we're starting to go down a little bit. We have a lot of surplus, but that's going to start unwind in 2026. So Baytex, we're talking heavy oil, and that's got a little bit of a boost here. And I do agree that we are seeing a breakout with Baytex. So for me, it's a little bit early as far as the seasonal perspective goes of when we'll be looking at energy stocks, but that is a positive breakout.
Okay, and we've got time for one more, and it's from Craig. Brookfield Corp reported recently, and the stock dropped sharply. Seems the results were disappointing. Is the stock currently a buy to you?
Well, I think longer term, I think Brookfield is in a great place. They're going to benefit some of the aspects of Brookfield itself, whether it's renewable resources, et cetera. Over the longer term, with some of the budget policies in Canada, is going to be beneficial to Brookfield and other infrastructure companies as well. I think Brookfield's probably at this point, if you look at the chart here, probably going to sort of bounce around here a little bit. We didn't see that breakout take place for Brookfield. So at this point, we've seen it pull back on the earnings. So I would say that I don't expect it to all of a sudden launch up here at this point. I think it's probably going to consolidate for a while before it starts to make its next move.
Any indicators when that might? No. In your crystal ball?
My crystal ball, yeah. It's more of waiting for a catalyst to change things, basically, where we see it actually start to say, okay, now this is undervalued for what's happened. They've got a big project or something. Something else is happening.
And that stirs things up. All right, we're going to leave it on that note. Brooke, thanks as always for joining us.
Thank you.
Appreciate it. Brooke Thackeray is from Global X. He was joining us on the show this morning on the street. Andy Bell's up next with the Open. The markets will open in a little more than 30 minutes. Have a great day.